Welcome back to today's Explainer, everyone. Today, we're diving straight into something that literally affects almost everyone trying to build wealth or scale a business, the overtrading trap. You know the feeling, right? Thinking that doing more, clicking more, trading more, selling more is going to lead to more success. But ironically, it completely destroys your consistency and sabotages your progress. So if you've ever felt like you're your own worst enemy when it comes to financial discipline, you are in exactly the right place. Just listen to this crazy confession from Lance, a veteran Wall Street trader who has made well over $100 million in his career. He flat out admits, "I have given back more money to the market from overtrading than most people will make in their entire careers." I mean, wow, that is a massive, self-inflicted wound. It just goes to show, overtrading isn't just some rookie mistake, it's a behavioral trap that affects everyone from absolute beginners to the top professionals. It's an emotional dependency on action. So here's how we're going to tackle this clinical intervention today. First, we'll define the overtrading trap, then identify the warning signs. After that, we'll uncover the root causes, build up your personal defense system, and finally, talk about mastering quality over quantity.
All right, let's jump right into part one, defining the overtrading trap. So what does it actually mean? Because as we'll see, it crosses multiple financial disciplines. A lot of folks think overtrading is just pressing the buy or sell button way too many times, but it's actually much deeper than that. At its core, overtrading is the critical depletion of your finite resources, stuff like your account balance, your working capital, or even just your mental energy, all because you completely lack structure. For a small business, overtrading means taking on a massive new contract, hiring staff, and buying inventory without the cash flow to actually fulfill those orders, stretching yourself to the absolute breaking point. In the financial markets, it means abandoning your playbook and taking setups that have absolutely no statistical edge.
It really comes down to disciplined execution versus falling into the trap. On one hand, you're patiently waiting for those A-plus setups on your charts, looking for proper indicators, and aiming for sustainable business growth. That's acting with a real statistical edge. On the flip side, the overtrading trap. That's chasing massive green and red candles just out of FOMO or exhausting your business's working capital just to feel like you're doing something. One is calculated, the other is sheer emotional desperation. Okay, moving on to section 2, identifying the warning signs. Now, I want you to be brutally honest with yourself when you hear this staggering statistic. According to studies from the Journal of Behavioral Finance, 71% of traders actually increase their trade frequency right after suffering a loss. 71%. Think about that for a second. Instead of stepping back when things get choppy or their strategy stops working, the vast majority of people just double down and start taking random, impulsive actions. Emotion completely replaces logic. It's absolutely crucial to recognize these symptoms across the board. If you catch yourself bumping up your trade frequency after a loss or ignoring your predefined rules, you're definitely exhibiting the signs. And actually, if sitting at your screen without an open position makes you feel physically anxious, huge red flag. For you business owners out there, this looks like having dangerously high stock levels tying up all your cash while customer payments are lagging. You are actively overtrading and operating right on the edge of insolvency. Which brings us to section 3, uncovering the root causes. Now that we know what it looks like, why do we do it? Professional traders will tell you this isn't a single standardized issue. It usually boils down to 5 main triggers. First up, lacking a playbook, just kind of trading on vibes without a checklist. Second is FOMO. Third is sheer boredom. Fourth is greed, taking oversized positions because you're dreaming of massive profits. And fifth, revenge trading, taking reckless action to make back a loss immediately, which almost always guarantees you're going to lose more. Let's zoom in on boredom for a second, because this one is incredibly sneaky. Markets and businesses simply don't produce high-quality opportunities constantly. But boredom, it creates this artificial urgency. During a slow market session, sitting on your hands feels really unproductive. So what happens? Your patience drops. You lower your standards. You start talking yourself into taking weak, C-level setups just to be in the game, reducing your hard-earned edge to pure randomness.
And then, of course, there's FOMO. I really love this quote because it validates the sheer emotional pain of watching a market surge without you. To them, the pain of missing out on the move exceeds the pain of taking a loss. It's so true, right? You see friends printing money on social media or a chart just rocketing up, and you jump in with terrible risk-to-reward ratios simply because your ego cannot handle being left behind. All right, so how do we fix this? Let's get into section 4, building your defense system.
Here's the harsh truth. Willpower alone is going to fail you. You absolutely need a system to protect your finite resources. Step 1 is setting maximum daily limits. Step 2 is enforcing a strict pre-trade checklist. And Step 3, which heavily gets emphasized by top professionals, is checking your physiological state. Seriously, poor sleep, being super stressed out, or even just fighting off a cold dramatically destroys your emotional discipline. If your brain is foggy, your rules should be to reduce your risk limits or simply refuse to operate that day. You essentially need to build absolute circuit breakers into your routine. Look at these structural limits: a hard maximum on your number of trades per day, a cap on your total daily risk percentage, and a max for consecutive losses. Like if you lose 2 trades in a row, you step away from the desk immediately. These aren't just suggestions, they act as a hard stop. They physically prevent you from letting one impulsive, emotionally compromised session undo weeks of disciplined performance.
And hey, for the business owners tuning in, your circuit breakers might look a little different, but they follow the exact same logic. You've got to monitor your cash flow mercilessly. Cut down on excess inventory. If you land a huge contract, consider leasing the equipment instead of buying it up front to preserve your cash. Negotiate longer payment terms with suppliers, and in severe cases, have the discipline to implement a sales hiatus. Literally stop taking new orders until your working capital recovers.
Which leads us nicely into our final piece of the intervention. Section 5. Mastering quality over quantity. This right here is the ultimate mental shift you need for long-term survival in any market. Think of this resource analogy. You are a sniper with a very limited number of bullets. Your capital, and just as importantly, your mental energy are strictly finite. You have to preserve them for A-plus setups only. This means maybe you only operate during specifically planned times, and if your indicators don't perfectly align, you do nothing. You must remind yourself that sitting out and protecting your capital is an active, highly profitable decision. To pull this off, you've got to make a massive paradigm shift. You have to ditch that toxic, money-obsessed P&L mindset and adopt a rigid process mindset. Stop obsessing over your daily monetary outcome. Instead, judge your success entirely by your adherence to your system. Did you hit your checklist perfectly? Did you manage risk? Was the setup valid? If yes, that's a successful day, even if the trade itself lost money. Once you truly internalize the process, you stop caring about revenge or being right, and the urge to overtrade just naturally fades away. Well, we've definitely covered a lot of ground today in this explainer, from diagnosing those destructive symptoms of overtrading to building a rock-solid process-driven defense system. But before we wrap up, I want to leave you with a direct question to really reflect on. How many trades or impulsive actions are you taking a day right now? And honestly, do you think sitting out more would actually improve your results? Take some time to review your own routines this week. Implement those circuit breakers, and remember, sometimes the absolute best strategy you can execute is doing nothing at all. Thanks for hanging out with me, keep learning, and I'll catch you on the next explainer.